Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 10 titled Covered Call Writing to Generate Premium and Dividend Income. We're going to use a real-life example with TLT, a Treasury Bond Exchange Traded Fund. Now, how many of you who write covered calls would love to capture dividend income in addition to the option premiums? Well, I could tell you firsthand, there are an awful lot of covered call writers that like this approach. So in today's presentation, we're going to discuss a specific security, TLT, and show you some of the considerations we must incorporate into our strategy if we're looking to generate two income streams with our covered call trades. So if we were to set our strategy goals, it would be the following. We're looking to generate cash flow by selling call options. Well, that defines covered call writing, traditional covered call writing. And if we were to do traditional covered call writing, there would be a stock selection process which involved fundamental analysis, sales and earnings growth, technical analysis, reading a price chart, looking for trend and momentum, and finally common sense principles like minimum trading volume, asset allocation, and things of that nature. Now that goes for traditional covered call writing. But there's also another way to do covered call writing for those of us that have long-term buy and hold portfolios, and we have stocks that we've owned for a very long time, and we'd like to leverage those stocks or ETFs to generate even higher returns by writing covered calls on those. So in that case, the stock selection is already done because we only want to write calls on securities that we already own. So there are various ways of using covered call writing. The latter, where we already own the shares, is known as portfolio overwriting. So it's a covered call writing like strategy. Now we want to add on top of that, we're going to add dividend capture. So we have two goals of income, one from the option premiums and the other from our dividend income. And if we're writing out of the money covered calls, we can even throw in a third income stream, and that's from share appreciation from current market value up to the out of the money strike price. Now, in this particular video, we're going to focus in on iShares 20+ year Treasury Bond ETF, which trades on the NASDAQ exchange under the ticker symbol TLT. Now, I'm creating this video in April of 2020. So as of now, the annual dividend yield for TLT is 1.75%. And it's an unusual security in that it generates dividends every single month of the year, with the ex-dividend date on the first of each month. Now, the ex-dividend date is the date that we must own the security in order to be eligible to capture the dividend. So this is a security that's been paying dividends now since 2002. So it's a fairly reliable security. But here's the issue with TLT. The main reason for early exercise of our options relates to dividends, and specifically ex-dividend dates. So if the option buyer wants to capture our dividend, that person will exercise the dividend the day prior to the ex date, and then therefore be eligible to capture the dividend. So we must focus in on the ex-dividend dates when we're using this strategy of capturing dividend income in addition to our option premium income. Now, a very reliable site to get this dividend information is www.dividendinvestor.com. Now, for those of you watching this podcast, I'm showing a screenshot now of what that site looks like for TLT. You could see on the top left, it shows a trailing 12-month dividend yield of 1.75%. On the right side of the page or screenshot, you see the ex date being April 1st, 2020. Every calendar month of the year, the ex date is the first. And dividends have been paid since 2002. So dividendinvestor.com is a very reliable, free site resource for getting dividend information. Now, once again, the dilemma when we're using this strategy for a security like TLT is that X dates are the main reason for early exercise. It's still rare, but if we're looking to capture that dividend as part of our strategy, we have to circumnavigate around the ex-dividend date. What that means is there cannot be an option in place the day prior to the X date. Now, one of the good news features of this strategy as it relates to TLT is that this security has weekly options. So it has options that expire every single Friday of the calendar year, not just the third Friday of every month. So what we could do is we could write weekly options on TLT every single week of the calendar year except the 12 weeks of the ex-dividend days. So we could write weekly options 40 out of the 52 weeks per calendar year. Now, if we checked, which I did, the one-week option chain for TLT in April 2020 when it was trading at 170.08 with a one-week expiration, the in-the-money 169 strike generated a bid price of 271, and the out-of-the-money 171 strike generated a bid price of $1.80. So again, with the stock trading at 170.08, we're going to look at the 169 in the money and the 171 out of the money. We feed this information into the blue cells of the basic Ellman calculator. And by the way, for those of you who do not have a copy of the basic Ellman calculator, at the end of this podcast, I'll tell you how you can all access a free version of it from the blue collar site. In any case, we feed the option chain information into the multiple tab of the Ellman calculator, and the results show us that we have a return on our option, or ROO, in the brown cells for those of you watching this podcast, of 1% for the in-the-money 169 strike and 1.1% for the out-of-the-money 171 strike. So you get an annualized return of over 50%, best case scenario. Now you could see here that the in-the-money 169 strike also had a 0.6% downside protection. What that means is we're guaranteed a 1.0% one-week return as long as share value does not decline by more than 0.6% in the 5 days of the trade. Now, the 1.1% out of the money 171 strike also afforded us 0.5% upside potential, which means that in addition to the 1.1% time value profit on the option premium, we also have the possibility of a 0.5% more if share price moves from 170.08 up to the 171 strike in the 5 days of the trade. So pretty good, very good actually in terms of premium generation using the weekly options. Now let's craft this strategy specifically for TLT where we can only trade 40 weeks out of the year. Well, that will bring down our 52% potential annualized return. It will reduce it to 40%. Still pretty significant. Now remember, the final outcomes are not yet determined. We don't know what the market's going to do during the course of the year. We also don't know how we're going to manage our trades because we have a lot of position management approaches that will mitigate losses and enhance gains. But that said, we're off to a great start with a potential 40% annualized returns on the premium only. And from there, we add in that 1.75% of dividend profit. So let's summarize. Ex-dividend dates must be considered when we're looking to generate option premium and dividend income. Weekly options are extremely useful with these dual goals. Now, this strategy also applies to securities with quarterly dividends. And that's actually most securities that generate dividends are generated every 3 months. So what we could do in those cases is that 8 months out of the year, we could use monthlies. And then the 3 months where the X dates occur, we could use weeklies and just circumnavigate around that 1 week of the ex-dividend date. So there are management strategies that we can employ that will dramatically minimize the risk of early exercise for the option buyer to then capture our dividend. Now, for those of you who do not have a free copy of the basic Ellman calculator, go to our website, www.thebluecollarinvestor.com. On the top black bar of our web pages, click on free resources, including the Ellman calculator. Put in your email address, and you can then download the device and its user guide right to your computer. We also have books and DVD programs that will help you master the strategy of covered call writing. The complete encyclopedias for covered call writing. The classic edition should be read before the volume 2. And we also have an updated covered call writing online streaming DVD program with downloadable workbook in our blue collar store. So those resources will help you elevate and help you master your competence with these strategies to the highest possible levels. So there you have it, ladies and gentlemen, BCI podcast number 10, where we're looking to generate not only covered call premium, but also dividend income. I hope you enjoyed this presentation, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.